Welcome to Intelligent Investor Insights with Joshua Barone and Robert Barone, your co-hosts and guides through the noise of today's markets. Here we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
So look at what happened on July 29th. That 12-0 unanimous illusion Kevin Warsh had back in June, it just completely shattered. The FOMC voted 9-3 to hold the federal funds target range at 3.50% to 3.75%.
9-3. And three hawkish dissents, Dad. Beth Hammack, Neil Kashkari, Logan, all three of them voting for an immediate 25 basis point hike. We haven't seen three hawkish dissents in a single meeting since September 2016.
Because the consensus was fake, Josh. Warsh came in with that brutally terse 130-word statement. I mean, it is the shortest statement since Greenspan was running things. No forward-looking promises, no hand-holding. And then he gets up at the press conference and basically tells the room, look, there is no soft inflation target. There is only a target, and it is 2%. And then he drops the real line. 5 years of inflation cannot be cured in 9 weeks.
I was sitting at my desk in Reno when that headline crossed the terminal. I nearly spilt my morning coffee all over my keyboard watching the CME FedWatch September hike odds leap from 38% to 72.3% in a matter of hours. That is what happens when you strip away the training wheels. Wall Street had no idea how to price September without a Fed nanny whispering in their ear.
And that is exactly why Warsh is right to put them in that 130-word iron cage. For 15 years, the Fed fed Wall Street forward guidance like pure sugar. It distorted asset pricing. It destroyed honest price discovery. Eliminating forward guidance forces traders to actually underwrite real economic data instead of front-running central bank speeches.
Okay, but Dad, when you yank forward guidance right in the middle of severe Middle East supply shocks, you don't magically get calm price discovery. You just relocate all that volatility straight into the long end of the curve. I mean, look at what the 30-year Treasury did. Yields shot up to multi-decade highs because the market is suddenly pricing in total uncertainty on long-term inflation.
Let us break down why that long end move is happening. When central banks abandon explicit guidance, institutional investors cannot anchor their cash flow models on policy path promises. They have to demand a term premium again. Remember what happened in the late 1970s and early 1980s under Paul Volcker. When Volcker stopped targeting money supply growth metrics and forced the market to price reserves directly, bond yields surged, but it eventually squeezed out structural speculative leverage.
That term premium argument sounds great in an economics textbook, Dad, but out here managing money for clients, a 30-year yield pushing to multi-decade highs wrecks real estate development underwriting and municipal borrowing overnight. If you are underwriting a $100 million cash flow project in Nevada or California, a 75 basis point jump in the 30-year rate changes your debt service coverage ratio from robust to insolvent. You cannot just hand wave away the real economy impact of long end volatility.
The long end is where volatility belongs, Josh. The bond market is supposed to price risk, not mirror Fed public relations statements. If long yields are rising, it means bond vigilantes are doing their job, telling Washington that massive fiscal deficits and energy shocks carry a price.
Well, Hammack and Kashkari and Logan clearly think the price isn't high enough yet. Their explicit argument for dissenting was that policy is currently not sufficiently restrictive. They said taking a small 25 basis point step now prevents abrupt and shocking policy later if energy-driven inflation gets baked into consumer expectations.
Let us analyze those three regional Fed presidents for a second. Beth Hammack at the Cleveland Fed, Lori Logan at the Dallas Fed, and Neil Kashkari in Minneapolis. They are looking at underlying core PCE inflation, sticky shelter components, and high wage growth metrics. But they are making the classic central bank error of treating a supply side shock like a demand side bubble. You do not fix oil refinery disruptions or shipping lane bottlenecks in the Strait of Hormuz by jacking up domestic borrowing rates for small businesses.
Dad, you know as well as I do that inflation expectations are reflexive. If consumers and business owners see headline energy prices jumping at the pump and at the grocery store, they demand higher wages. Then landlords raise rents to preserve real yields, and suddenly cost push inflation turns into systemic structural inflation. That is what Logan and Hammack are terrified of. They don't want to wake up in 6 months with core CPI at 4.5% and realizing they sat on their hands.
And that is where the dissenter logic completely breaks down. They are walking straight into the 1974 policy trap. In 1974, Arthur Burns and the Fed kept tightening into a severe geopolitical oil supply shock. You cannot cure an oil supply disruption by crushing domestic demand with interest rate hikes. Holding at 3.50% to 3.75% carries far less downside than hiking into a supply-driven slowdown and wrecking real economic growth.
Okay, let us talk about the credit market dynamics, because credit spreads are telling a very different story than bond market vigilantes. High yield credit spreads are still sitting near historical tights. If the economy were truly falling into a stagflationary trap right now, junk bonds would be blowing out. Private credit managers are still deploying billions, and corporate balance sheets are refinancing debt into floating rate structures or extending maturities. Where is the credit breakdown you are predicting?
Credit spreads are a lagging indicator, Josh, and you know it. Private credit is playing a massive shell game by extending and pretending. They are deferring interest, restructuring debt agreements into payment-in-kind structures, and masking defaults because there is no public mark-to-market daily pricing. When corporate maturities wall up in late 2026 and 2027, those private credit funds will face a reckoning that junk bond spreads aren't pricing in today.
Fair point on private credit opaque pricing, but look at consumer balance sheets. Credit card debt hit another record, revolving debt balances are surging, and subprime auto loan delinquencies are climbing past pre-pandemic peaks. That is the lower income bracket being completely squeezed by food, shelter, and energy prices. But high income households, who hold 80% of equities and residential real estate wealth, are still spending freely because asset prices remain elevated. We have a completely bifurcated two-track economy.
A bifurcated economy driven by artificial asset wealth is inherently unstable. If high income wealth effects are sustaining services consumption, while low income families borrow at 26% credit card interest rates to pay for groceries, you are building a house of cards. When equity multiples compress due to rising 10-year and 30-year Treasury yields, that wealth effect disappears fast. That is why Warsh is refusing to pump equity markets with dovish forward guidance.
I agree you can't print oil, Dad, but look at what the currency and derivatives markets did. Right after the announcement, the dollar index took a wild round trip, dropping 0.6% on the initial hold, and then completely reversing and rallying as those September hike odds climbed to 72.3%. The spot headline move was a total head fake. The true cost of capital is being set right now by yield curve steepening and derivatives, not by whether the spot funds rate moved today.
Look at the global spillover effects as well. When the US dollar strengthens because market participants price in higher terminal US rates, emerging market currencies get crushed. Central banks in Europe, Japan, and developing nations are forced to demand their currencies, driving up global liquidity strains. The Fed is not just managing domestic interest rates, it is managing the world's reserve currency anchor. Warsh understands that maintaining dollar credibility requires demonstrating independence from short-term political pressure and Wall Street whining.
Speaking of political pressure, let us talk about the elephant in the room. Fiscal policy is completely unhinged. Washington is running $2 trillion structural budget deficits during an expansion phase. The Treasury Department has to issue massive amounts of new bills and coupons every quarter to fund federal interest expenses and entitlement spending. The Fed can manipulate the short-term rate all at once, but if supply of Treasury issuance overwhelms demand from foreign central banks and domestic buyers, yields must rise.
That is the fundamental fiscal dominance issue I have been pounding the table on for years. You cannot achieve long-term price stability when the federal government is running 6% budget deficits relative to GDP. The Fed is trying to tap the brakes on monetary policy, while the Treasury and Congress are flooring the accelerator on fiscal spending. Warsh knows that if the Fed monetizes those deficits by keeping rates artificially low, hyperinflation risk escalates. Holding steady and letting the Treasury face market discipline is the only courageous stance.
So how do we position client portfolios in an environment like this? As a value-focused financial advisor, my playbook requires margin of safety. First, we keep duration short in fixed income portfolios. We are allocating cash into short-term Treasury bills, yielding high rates without taking duration risk on 30-year bonds. Second, in equities, we avoid high multiplier growth stocks that depend on ultra-low long-term discount rates and focus on cash flow heavy, dividend growing, defensive businesses with pricing power.
And third, hold real tangible assets and commodity hedges. Gold, energy producers, and infrastructure assets with inflation-indexed cash flows belong in every serious portfolio today. Paper assets relying on perpetual central bank put options will continue to underperform real assets in an era of fiscal dominance and structural inflation volatility. Investors must stop relying on central bank promises and return to fundamental cash flow analysis.
Precisely. Now, looking ahead to the September meeting, we have 2 full months of CPI numbers and labor reports coming down the pipe.
Right, but if those upcoming inflation prints stay sticky because of crude oil and shelter components, Warsh's own data-dependent framework might trap him. He either has to give in to the hawkish trio and hike in September, or hold steady while 30-year yields keep climbing and tighten financial conditions anyway. If he holds steady, he proves he has the stomach to let the market set long-term rates. That is not a trap, Josh. That is sound monetary economics.
We will see if Wall Street agrees when September rolls around. Good talk, Dad.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late-cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional-level analysis, and a partner in building durable wealth. Reach out to start the conversation with a member of our team, Robert, Joshua, Andrea, Mike, or Eugene, and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.